market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, President Donald Trump's sweeping tariffs are to take immediate effect after they are announced today. The plan is down to the wire, with sources saying his team is finalizing the details just hours from an event in the White House Rose Garden. Now, we're joined by Freya Beamish, chief economist at TS Lombard. Also with us, Ross Matheson, Bloomberg's EMEA News Director, and Brendan Murray, who leads our global trade coverage. So thank you all for joining us. Brendan, let's start with you. When you see the fact that actually it's down to the wire, what does it tell us about the White House? Is it second thoughts? Is it that they don't know how to do it so that it doesn't hurt the economy too much? Or what's the thinking?
It sounds like there's a vigorous debate still going on inside the White House, or at least there was heading into this morning, about one of three options that they seem to be weighing up. One is a flat tariff rate for all countries, say 20, the number 20% is thrown around. The second one is a more customized, each country gets its own tariff rate based on an analysis. And then the third is something in between, kind of a tiered structure where countries are divided into buckets, and each one of those buckets gets a specific tariff rate, like 15, 20, or 25%. So it sounds like President Trump has some options on his desk, and he's still yet to make that decision.
Ross, and I feel like this could be a protracted, I guess, conversation, right? It doesn't feel like it's a one and done. So it feels like it could be a negotiating starting point instead of actually just trying to bluntly take money from other countries to bring them back to the Treasury coffers.
Well, that's right. And as Brendan was saying, the fact there's a debate down to the wire on this shows that not only are there potentially a bunch of different goals that they're trying to achieve with these tariffs, but a bunch of different ramifications. And so they have to factor in all of that, the competing goals, the competing impacts. Are you trying to just bring money to the US? Are you trying to support US companies? Are you trying to support the US economy? Or are you risking, hitting the US consumer, changes to growth and inflation in all of this? So, in trying to build coffers ostensibly to give them room on taxes, are there knock-on effects? So obviously that very vigorous debate going on, but Donald Trump is nothing if not a negotiator. I mean, even the White House press secretary said yesterday the president's always up to take a phone call. He's always up for a good negotiation, which indicates that, yes, he's willing to look at this in the aftermath of the announcement. And it probably will be designed in the end to allow that wiggle room for negotiation. Perhaps things, even if they take effect immediately, there's a period of adjustment that will be baked in somehow. It allows countries to put forward further cases. We've seen him do that before. So certainly the calibration, all of this and all the other complexities is how to make an announcement that does create that space for negotiation, because it's clear that Donald Trump does want that.
And Freya, we keep on hearing actually from the Trump administration that some of the measures that will be announced today will help and not hurt the economy. Is that even possible?
I think we have to think very, very carefully about the direct effects of tariffs versus the indirect effects of tariffs. The indirect effects of tariffs are actually causing a genuine, benign rebalancing of policy that should have happened probably about 10 or even 20 years ago across Eurasia. If we look at how Germany is responding, even how China is responding, and that comes hand in hand with the broader political dynamics that each of these countries are facing at the same time, with the rise in inequality and decline in labour share of income. So all of these policymakers are sort of trying to find solutions, and the indirect threat, or the threat of Trumpian policy on Europe is helping to rebalance. And if you believe, as we do, that the global imbalances make a mark on the US economy, then in that sense there could be some kind of positive outcome here. But in terms of the direct effects of tariffs, it just, to me, is something that is the wrong choice of industrial policy. There has to be some form of industrial policy at this stage in the game, because it's now abundantly clear, and has been for like over a decade, that the global trading system is not the fair global trading system that economists had sort of hoped for. And so if there has to be some form of industrial policy, the question is, are you going to inject something that is going to cause a positive demand shock, which we think would be a very benign thing given where the labour share of income is in a historical sense? Or are you going to do something which is a negative supply shock, which is something which, as an economist, gets my heart racing for all the wrong reasons, because it's all sorts of very negative things happen in the economy when you get negative supply shocks. So those two different forms of industrial policy, positive demand shocks, which are sort of tax cuts, subsidies, versus negative supply shocks, which is tariffs and deportations, will probably create a rebalancing, but they will have a very different implication for real growth over the next kind of 3 or 4 years.
But Freya, is there a way of doing some of these tariffs, whether they be a negotiating point or whether it's something that's here to stay, in a way that it minimizes inflation and also minimizes the impact on GDP?
Making a small number, I think what we're expecting to see is to the extent that one can say anything at this point in time, is that a negotiating position to start with, and this isn't the end of the story. But we are expecting tariffs to be settling at around sort of 8, 9, 10% in addition to the 2% that we already have for the US economy as an effective tax rate. Now that is the highest number that we can really get before we start to be worried about sort of big bear stories and about sort of reflexivity kicking in the economy.
Yeah, we have viewer questions. Thank you so much for the viewer that's writing in. We love viewers putting in questions. Brendan, this one's probably one for you. So the question is, doesn't Trump want the revenue generated from these tariffs to pay for as many tax cuts? So do you see much room for him to negotiate lower after today's announcements? I mean, are you expecting big and then temperance?
Yeah, I think that's a really good question, because there are those who would say that if you try to reshore manufacturing to the U.S., that you don't get those revenues. You might create a lot of factory jobs, but then it works against your goal of raising revenues. So there's some one counters the other, and so I think one of the main things we should keep an eye on today is the style and the substance of what we get. We've got a big ceremony, some pageantry in the Rose Garden. Do they use tariffs as a tool to constructively, or is this to break the system? I think that will be a key thing for markets to keep an eye on.
Yeah, it's quite an event. Cabinet officials, lawmakers have been invited to announcements. There's also workers and executives from the U.S. steel industry. So it seems, according to people that we've spoken to, that this is, a statement, if nothing else, for a domestic audience.
Yeah, exactly. One of the interviews that Bloomberg TV recently did was with Catherine Tai, and she said, it'll be interesting to watch the precise tariff numbers that come out. If they're nice round numbers, 20%, 15%, then you can take the message one way. If they're 17.5 or 21.2, you'll be able to tell that there was some economic analysis built into it. So drama or its substance, I think, will be a key question coming out of this.
I mean, Ross, one of the things, of course, that we were discussing is this idea that one of the approaches could be the U.S. really laser focusing on individualized reciprocal rates. So it would basically be tailored to countries based on, their existing levies, but some of the non-tariff barriers that they've put in place. Ross, I mean, this would feel like, I guess, more foreign policy, or would this be to, reward the good actors, or is it because they'd be worried of reciprocal tariffs the second time around?
Well, again, it's really Trump using tariffs as a foreign policy lever as well as an economic one, and one, as you're just talking about, really to build his domestic agenda. So he sees tariffs as a multi-use tool in a way, and he doesn't like sanctions. So even when he's talking about sanctions, he's essentially referring to them as tariffs. But what he's basically doing is showing the world that whether you are a long-standing US ally for many years in Europe, in Asia or elsewhere, or whether you're an adversary, a country that's had often a hostile relationship with the US, that he's looking at each of these countries purely through the lens of, well, what is the business relationship like between our countries? What do we import? What do we export? What do we get out of this? As, again, a deal maker, what do we, the US, get out of this? And it doesn't matter if you're an ally or an adversary, he looks at you in a way quite equally. Perhaps he's willing to give you a little bit of leeway if he's got a personal relationship with you as the head of state. We can see that that's sometimes benefited some countries because he feels like he has a rapport with the leader. But again, he really looks at this purely through the prism of what money is coming from you to the US and what US money is going out to you. And so very much using tariffs as a lever of foreign policy as well to penalise countries who take policies he disagrees with, and even using tariffs on policies that have nothing to do with the economy whatsoever. If a country takes an action on foreign policy he doesn't like, he'll say, fine, we're going to tariff you in response. And so really it's a completely different, complex world for a lot of these countries to be dealing with when it comes to the relationship with the US. And again, whether you're your friend or foe.
And, of course, Freya, as you rightly say, the main risks to growth are probably demand destruction owing to this loss of purchasing power. Is there any way of, do you see signs of that already in the economy? I know there's going to be a lot of focus on non-farm payrolls on Friday to look at the state of the U.S. right now.
Well, there's been a lot of front-loading besides anything else, so that there can be a little bit of a weakness on the other side of that if certainty ever arrives. But I think the way we've sort of like calibrated our base case is that it's the biggest number in tariffs that you can get, so 8, maybe 9, 10%. That doesn't kick in that reflexivity. And the reason why we've done that is because despite the rhetoric, we still think that there is some guardrail that is offered by the S&P to the economy. Now, the issue is that if we start to get a lot of volatility on the path in terms of the tariffs and actual inflation effects, on the path to that sort of 8, 9, 10%, that becomes very problematic in and of itself, because that starts to really increase the precautionary savings in the economy. And it could actually start to have some serious market effects at the long end of the curve, thinking about the term premium. If we look back through history, the moments in time when you see blowouts in term premium is when you have negative supply shocks. And we don't really have a good way of calibrating whether tariffs could have that effect, but they are a negative supply shock. And so that's a source of concern there, particularly thinking about your viewer's question. If this is supposed to be a source of fiscal revenue, and that's the key difference this time around compared with last time around, and we do think that the key players see it as a source of fiscal revenue, at the same time as perhaps initially generating some fiscal revenues, you're also running the risk of pushing up term premium and increasing the interest you have to pay on existing debt.
So, Freya, I mean, the two questions, and I know Brendan here with me in the studio will be watching out for how the president also addresses China and his main message to China. So it's, how does China factor into all of this, Freya? And the second question is really, what does it mean for the ECB and the Fed? If you have this inflation, do they wait or do they become more hawkish?
Yeah, I think China has already started to respond, partly as a result of honestly rising unrest domestically, because not only has inequality risen in the US, it's also risen in China. But they're also responding because they see that the rest of the world is no longer willing to take the excess supply that is created by a very supply-oriented policy. And so in September we saw that pivot towards domestic demand at the margin, and that seems to have been confirmed by the numbers that came out of the NPC in February. So China starting to kind of respond, and we think potentially there could be some interesting deals there. Thinking about the response of the ECB and the Fed, the ECB, they have this hawkish tendency. I think we are going to be quite clearly in a disinflation regime. I don't think there's going to be sort of retaliation to the extent that we're going to see a big increase in inflation in Europe. And so I think the ECB will be able to continue cutting rates and supporting the economy, which will probably be a benign thing for the bloc. In terms of the Fed, it makes things much more difficult. Is this negative supply shock? Central banking 101 is you don't respond to a negative supply shock, but on the back of the pandemic, that sort of changed a little bit for various reasons. And so it's very hard for the Fed now to support the economy until they see that weakness, until they're sort of seeing the whites of the eyes in the labor market, and then at that point, then we can start to think about the Fed cutting rates. But that's not a great situation for markets.
Yeah, and Brendan, on China, again, it seems like China was pretty focused at not antagonizing the U.S. too much. Does that change depending on what's said in the Rose Garden today?
Yeah, absolutely. I think the big question that we're going to be asking ourselves at the end of this announcement is, what has the word that we've heard over and over again over the past several weeks, uncertainty, has that been resolved? Do companies, consumers, governments go, okay, there's my tariff rate, let's get on with things, let's negotiate, and, or does it start the spiral of retaliation and sort of the cycle of sort of economic damage that countries can inflict on each other in a full-blown trade war?
Okay, thank you all for joining us. Freya Beamish, Chief Economist at TS Lombard, as well as Bloomberg's Ralston Matheson and Brendan Murray. It's going to be a big, big day, I know, for everyone here. Now, a redhead crossing the terminal a few minutes ago. Bloomberg understands that Italy's second largest bank, UniCredit, is analyzing options to replace Crédit Agricole's asset manager Amundi when an existing sales partnership with the firm expires in about 2 years. Now, it comes amid signs that the French bank does not support the Italian lender's takeover bid for a smaller domestic rival, Banco BPM. You can see there's a bit of pressure on Amundi, down 3.6%. UniCredit also lower. Now, the U.S. Commerce Secretary will be on Bloomberg surveillance today. Catch that conversation with Howard Lutnick, and that is at 1:30 p.m. London time tomorrow. Coming up, Europe says it's preparing to respond to President Trump's tariffs. Details ahead, and this is Bloomberg. European leaders are promising a strong plan to retaliate against Donald Trump's so-called reciprocal tariffs. Now, the European Commission's president says the EU is still aiming for a negotiated solution.
So many Europeans feel utterly disheartened by the announcement from the United States. Let me be clear. Europe did not start this confrontation. We think it is wrong. But my message to you today is that we have everything we need to protect our people and our prosperity.
Well, sources tell us that officials are considering legal measures as well. Bloomberg's Oliver Crook joins us from Berlin. Good morning, Ollie. Happy Liberation Day to those who celebrate. I mean, this is, we joke about it, but this is a huge market day, and it's going to be an event, and a lot of the politicians have to deal with it without really knowing in advance what will be done. So what levers can Europe actually pull today?
That's exactly right, Francine. Everybody knows what it's called, Liberation Day. No one knows what it means, and basically they're all waiting sort of with bated breath for what that will be revealed in a few hours' time from the Rose Garden from the President of the United States. And the response will be obviously in large part governed by the great mystery of what is going to be revealed. Could it be just a blanket tariff across the board? Could it be tiered? Could it go country by country? I mean, the IFO Institute just put out a sort of a bit of research here for the impact that it could have on the German economy, and I'll quote it to you directly to kind of show you the difference between all of these different options. A true reciprocal tariff, they say, between Germany and the United States, the U.S. and Germany, would only actually raise tariff rates by 0.5%. That is very, very small. That would actually only hurt exports from Germany to the U.S. by 2.4%. However, if we're looking at a 20% blanket tariff across the EU, that would hit exports from Germany to the U.S. by 15%. And that says nothing of the fact, and you touched this a little bit earlier in the show, Francine, with Roz Matheson, about basically what about other sort of economic goals that the Trump administration could try to achieve with these tariffs. It's not just necessarily closing the trade gap between the EU and U.S. economies. It might go even further. And if they do that, the EU could respond with this is another acronym we're going to have to get used to, the ACI, the anti-coercion, one of the mechanisms that the EU has. And that is much more expensive. That goes further than trade. That goes into sort of direct investment. That goes into intellectual property. So all of these different options are on the table right now, to say nothing, Francine, of the fact that just to make things a little bit more complicated, hours after the tariffs come into effect, you get the Secretary of State Marco Rubio landing in Brussels to have a NATO meeting. We need not forget that the Europeans still need the U.S. on side for Ukraine, for defense going forward. So all of this stuff is going to go into a very sort of delicate equation for the European policymakers as they try to assess their response to Donald Trump.
So how are European companies preparing, Ali?
So listen, I talked to BMW a couple of months ago about the tariffs just to Mexico and the United States. It said that they were going to. They said it was going to cost them €8 billion, to say nothing of the sort of tariffs across from the U.S. to Europe. We have overnight some reporting saying that Mercedes-Benz basically is now looking at withdrawing their entry-level cars in the United States because they're just not economically viable anymore with 25% tariffs. And Francine, that's just the beginning, so we'll keep an eye open for how that develops over the next couple of weeks.
Ollie, thanks so much. Oliver Crook there with the very latest from the European side. Now let's also bring in Bloomberg's global card czar, Craig Trudell. Craig, I mean, it's going to be a busy day, probably a busy couple of weeks. And then if you look at the industry group that probably has a lot at stake, maybe one of the most that has at stake is the car makers, because we've also seen that lobbying from U.S. car makers saying, look, a lot of our parts are in Europe, and it's just going to get messy.
Yeah, the parts makers and the end manufacturers don't have 25% to give, right? This is an industry that is an extremely low margin one, very global, and it is reliant on, just-in-time, of lean manufacturing principles. So this will be hugely disruptive. I think maybe not necessarily right out the gate, in the sense that I think we have every reason to conclude and expect that manufacturers did their darndest in the weeks leading up to this to try and get as much into the U.S. as possible. But we will see, to Ollie's point, likely some changes to lineups, some decisions to just cut some models altogether that are entirely imported. But you have some brands that don't have that option. You have Porsche, for example. Everything that they make everything that they sell in the U.S., they make elsewhere, and there's not a clean, easy solution for the Volkswagen Group to start manufacturing Porsches in the U.S. There isn't any shared, underlying platforms for those vehicles with the Volkswagen vehicles made in Tennessee, for example.
But, so great. Who has the most to lose? I mean, again, can you ship parts and keep them in the U.S. and they're not tariffed? Are there ways to go around it? And how much of the supply chain was already changed the first time round that Trump was in charge?
I would say we've seen the parts supply base really, try to localize more. There's been more of this sort of view of having a local supply chain close to your end manufacturing point is, positive, even if it means higher costs close to that plant. I do think that we may see some of that on the margins, but to expect that to happen overnight or even within a year is probably unrealistic, and that's something that the industry has been trying to get across the White House. Look, we're going to make the investments here, but if you do this to us, it's going to hit us before that manufacturing, that fresh manufacturing catches up.
Craig, really quickly, Tesla's sales continue slumping in Europe. Is that an anti-Musk factor?
I think, especially in the month of March, a 37% decline in France really is incredible, because we should have started to get new Model Y supply into this market. So to see that number still be so bleak after the first couple of months of the year is really a sort of red flag.
Okay, Craig, thanks so much. Craig Trudell there with the very latest on car makers. Now, coming up, Novo Holdings has released their 2024 financial results, delivering higher than expected returns. We'll be talking to the chief executive of the company, Kasim Kutay. That's coming up next, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. The countdown is on to Donald Trump's announcement of so-called reciprocal tariffs. Bloomberg understands his team are still finalizing the details. Mercedes considers pulling its cheapest cars from the U.S. as automakers make a last-ditch attempt to sway the U.S. administration. Plus, how Trump's tariff threats are taking the pharmaceutical industry into uncharted waters, threatening 3 decades of WTO protection. Now, for more than 3 decades, the pharmaceutical sector has been protected from tariffs by a World Trade Organization agreement designed to improve access to life-saving drugs. But as U.S. President Donald Trump prepares to launch a new wave of levies aimed at reducing America's trade deficits and bringing manufacturing back to home soil, pharmaceuticals are high on the list of targets. So to unpack all of this is our senior health reporter, Naomi Kresge. Naomi, thank you for joining us. So what are companies doing to mitigate potential impact?
Hi, Francine. Good morning. So, for some time, companies have been trying to bring manufacturing to the major markets where they sell medicines. And so, we've seen European drug makers already have significant factories in the U.S. Many U.S. drug makers also have significant production in Europe. And this is part of the challenge for the industry right now. They have supply chains that really stretch around the world. There's also a lot of uncertainty about exactly what will be tariffed. Will it be drug ingredient? Will it be finished drug? Some are telling us drug ingredient is more likely. So just a tremendous amount of uncertainty and a lot of sense of not knowing what to do yet to mitigate. It's also worth noting that to build a new factory for medicines takes 3 to 5 years. Even just transferring a medicine that you're making outside of the U.S. into a factory that's already existent in the U.S. could take a year. So there are long time frames here in play.
You have a story, Naomi, that quotes a chief executive of a large drug maker that patients will ultimately pay for the price of tariffs.
Yes, that was Richard Steiner, the CEO of Sandoz, the biggest generic drug maker in Europe. So when he says patients paying the price, he's not only talking about higher prices, but also about the possibility of less access to certain medicines if margins get so small in certain areas, particularly in the generic drug industry, that some makers may not be able to participate in the market as they had before. And so there are concerns that in certain areas of generic drugs, access could become an issue. There's also a lot of uncertainty about whether certain medicines could be exempted from tariffs. Medicines that are, crucial drugs for patients, in the U.S.
Okay, Naomi, thank you so much. Naomi Kresge there with a wonderful story out on the Bloomberg terminal. Now, Novo Holdings, responsible for managing the assets of the world's largest philanthropic fund, has released 2024 financial results with total income and investment returns hitting 8 billion euros, up nearly 4 billion euros from the previous year. However, total assets under management fell to 142 billion euros, down from 149 billion, driven by a decline in the market value of Novo Nordisk. A lot of numbers in there, a bit like tariffs. Let's discuss the company's investment outlook and how its positioning may be impacted by the Trump administration. Well, with us now, Kasim Kutay, the chief executive at Novo Holdings. Kasim, as always, thank you so much for joining us.
Thank you for having me.
So first of all, we have your results.
Yes.
They all seem in line. Let's start on tariffs. How do you expect it to actually change some of your work at Novo Holdings?
Yeah. Well, look, I think as you pointed out, or I think there was an interesting article in Bloomberg yesterday where the headline was "We're in uncharted waters," and we are in uncharted waters because tariffs have not been applicable to pharmaceutical products, as you well know, for decades. So not only are we looking at the potential of having tariffs on pharma products, but because we don't have the precedent, where are they going to fall? Are they on cost of goods? Are they on the final value of our product? So until we have better clarity, it is very, very difficult to judge how and what the response is going to be.
But if you go from, I guess, multilateral, from bilateral agreements, does it change the calculation on investments and all, on future investments, on research and development?
Well, it's very difficult in this period of uncertainty. I mean, I think at the end of the day, research and development will continue. I mean, there's additional challenges, but whatever tariffs come in place, at some point the dust will settle. We don't know what the reciprocal retaliations may be as well. So there's a lot of guesswork here. So I think it's very, very difficult sitting here today saying, how are we going to respond? What are we going to do? We need to see what's going to happen. The uncertainty is just too high for me to be able to give you an answer as to what our response is going to be.
That's fair. You've also, I think, come back from China. How interesting is China at the moment?
Well, China's interesting. I mean, obviously, valuations looked extremely attractive at one point last year. And of course, there was the DeepSeek moment and perhaps an inflection point. But I would say what was interesting for me in China is it is very clearly, and perhaps this is obvious to many in your audience, but it's no longer about cost, speed, efficiency. In many ways, it's a quality story as well. So if you look at what's happening, particularly on the AI tech front, if you're looking at what's happening on the green transition and sustainability technologies, EVs, healthcare in particular, they have really moved up the value chain and are clearly closing the quality gap. So a very strong story, and biotech is very interesting. I mean, we did 2 transactions last year where we acquired the ex-China rights for molecules outside of China. If you told me 10 years ago or 5 years ago that we would be doing 2 venture biotech transactions in China, I wouldn't have believed you. But today it is a reality, and we're likely to do more, and so will others. We've seen many others investing in China because of the leap that they're taking from an innovation and technology perspective.
And Kasim, I mean, in terms of acquisitions or transactions, would the holding company entertain another large acquisition to support Novo?
Well, I mean, item number 1 of our strategy is to be a supportive owner of the Novo Group companies, and we assisted with 2 very significant transactions in the last 18 months. We forget there was the merger of Novozymes with Christian Hansen to create Novo Nordisk, where Novo Holdings played a critical role, and of course there is Catalent. Now, those things don't happen every day. These are defining transactions. They're very large transactions. So, of course, if the need arises, we will be there to support our companies. But it's very difficult to foresee when these things will happen.
But is there a particular area that you'd be interested in? I mean, if there was another Catalent to show up, is there, something that, if you leave valuations or regions out, that you would be interested in having as part of that portfolio?
No, but that's really driven by them. So when we're supporting our portfolio companies, it's them who say, look, we want to do this, and we think Novo Holdings can play a role in helping us. So it's very difficult for me to comment. But in terms of what we're interested in, I mean, the strategy is very clear. Our results speak for themselves, obviously. It was a record year, 18% return on the investment portfolio, and that's excluding Novo Nordisk and Novo Nordisk and the income we get from them. Just purely our investment portfolio generated its highest return ever. And that's on the back of our deep commitment to life sciences, continuing to invest very heavily there, continuing to invest very heavily on the venture side, and, of course, continuing to build out our presence in Asia with hopefully an office in Mumbai very soon.
I mean, that's very exciting. A lot of the focus is actually on India and Mumbai. Would that be to also, help support regionally some of the initiatives in health? And, is that also a way to, I guess, fill in the gap with the U.S. disengagement on health policies?
No. It's, expanding in Asia has been part of our strategy for a number of years now. And we're in Singapore, we're in Shanghai. And, of course, India being as big as it is, we started investing in India pretty heavily 3-4 years ago. And it was just very clear with the growth of the portfolio now to 6-7 assets that we needed feet on the ground in order to manage the portfolio, but also, frankly, to invest a lot more in a country where we see huge potential for healthcare.
Yeah, where do you see the biggest opportunities, actually, across the world, given these shifting sands?
Well, I mean, in the life sciences in particular, we continue to be very bullish on biotech. I don't know if you saw, but we deployed a record $700 million plus into biotech venture last year. The team generated a fantastic return of 15%. So we're today clearly one of the largest biotech venture players. So we continue to see the golden era of innovation that I've often talked to you about really pay off. Of course, there's a lot of volatility today. We had a recovery in 2024. IPOs were getting done. Financings are getting done. A lot of things are on hold right now. The biotech index is down. But we think that's temporary. At the end of the day, that market will continue to perform. So I don't know whether we'll deploy another record $700 million plus into biotech venture in 25, but certainly we will continue to invest very aggressively in biotech venture. We will continue to do a lot in Asia, and we will continue, of course, to do a lot in the U.S. and Europe. So it's the same geographic footprint.
Yeah, away from tariffs, but also because of the U.S. policy when it comes to health and health policies, do you see more grant applications or job applications in Europe? Does it shift actually where the brain power goes?
Well, I think, again, and I was reading an article a couple of days ago that, certain scientists are beginning to think about, where best to work and operate from. But I really do think it's way too early days. I think there's a lot of knee-jerk reactions right now to a lot of things, and we need to, nobody knows. I mean, I think, part of the reason that gold is up 18% so far this year off of an incredible high already is less policy per se and more uncertainty. I just don't think people know where we're going and where ultimately we're going to land. And the same uncertainty you see from the FOMC, right? If you look at where people are predicting rates at the Federal Reserve Board for end of next year, it ranges from about 2% up to 4.5%. So it's, your guess is as good as mine, as I said earlier.
Yeah, it's going to be a wild ride. Thank you so much for joining us. That was, of course, Chief Executive Kasim Kutay after some pretty good results. Now, since Donald Trump's last term, the European plane makers, Airbus, has diversified its suppliers, including a factory in the U.S. But its American rival Boeing imports parts from Mexico and Canada, which now face tariffs. Well, Bloomberg's Guy Johnson reports from the French city of Toulouse, the home of Airbus, on how it looks to be better positioned than Boeing for the upcoming tariff war.
These giant nacelles will soon become the key connection between an Airbus aircraft and its jet engines. Supplier Safran makes about 400 of them every year here in France. But since Donald Trump last imposed tariffs on steel, aluminium and aircraft during his first presidency, the company has significantly broadened its geographical footprint.
Our coding centers are next to the final assembly lines, so in China, Tianjin, in Alabama, USA, in Hamburg, Germany, and in Colomiers, Toulouse, France. This way, the final assembly line doesn't have to suffer any burden.
This is the Airbus A321 XLR, the youngest in its family. It has a nose from France, a body from Germany. The wings come from Wales. The rear stabilizer comes from Spain. Avionics come from America. When it comes to engines, you have a choice. You can either go American or French-American. It's up to you. Airbus relies on as many as 18,000 suppliers worldwide to produce roughly 80% of the aircraft. To manage tariffs, the company has the option of using its US factory in Alabama.
We are procuring from everywhere around the world, assembling there in the US with US jobs, to US airlines as well. So I think we are key to the US ecosystem, to the aviation ecosystem, and we think that plays a big role in how tariffs are targeted.
In the end, Forey says that new tariffs may hurt Boeing more than Airbus. The US company uses parts imported from Mexico and Canada and does not manufacture in the EU. It could also lose out in the growing Chinese market. Unintended consequences of the new transatlantic trade war.
Guy Johnson there reporting from Toulouse. Now, we also have a bit of breaking news from Greece. Greece is going to spend some 25 billion euros on defense over the next 12 years. Now, this was announced just a short while ago from the Greek Prime Minister, Mitsotakis, and this is as he unveiled his government's 12-year strategy to boost military capabilities. Again, the Prime Minister is saying investments in our defense capabilities are investments in our sovereignty. Coming up, the countdown to President Trump's sweeping tariff announcement in the White House Rose Garden later today. We discuss all of this with Bloomberg's head of economics and government, Stephanie Flongers. This is Bloomberg.
Liberation Day. Liberation Day is the beginning of Liberation Day.
April 2nd is a liberating day for our country. We're going to be getting back some of the wealth that very, very foolish presidents gave away.
We're in the process of imposing reciprocal tariff. The numbers will be lower than what they've been charging us, and in some cases maybe substantially lower, but we sort of have a world obligation, perhaps. Friend has been oftentimes much worse than foe. That money's going to be coming back to us in the form of tariffs. We're going to be very nice. Relatively speaking, we're going to be very kind.
Well, President Trump there speaking about his plans for so-called reciprocal tariffs and what that means to rebalance the U.S. trade relationship. Now, for more, let's bring in Bloomberg's head of economics and government, Stephanie Fonders. Stephanie, thank you so much for joining us. I mean, look, I could talk to you about this for like 3 hours to try and understand what's coming. But first of all, how much do we understand about what Donald Trump actually wants to do? This is, in his mind, he wants to rebalance the wrong that the U.S. has been submitted to for the last decades.
He's decided, and of course we can get into it because obviously he wants to use tariffs for a lot of different things. Yeah. But the essence of the reciprocity idea is to unpick the basic system on which the global trading system has been based, the basic principle, which the US has helped to underpin since World War II, since the whole Bretton Woods conference all those years ago. And that's that in effect the way the system worked was you would have the developed economies, and particularly the US, would lead the way in opening their economies and be progressively helping to lower trade barriers, not just for their own economies, but also around the world. And a rising tide would lift all boats. It certainly did. We had rising global trade as a share of the global economy. It is true that in this scenario, particularly developing economies, poorer economies who were in Asia, many of them very poor at that point, had higher barriers around their economies than the US did. But the bet by successive US administrations was that's worth it in the long run if these countries get rich and provide markets for us. He is fundamentally repudiating that. He says that for too long, countries have taken advantage of that. Even as they have got rich, they have still had trade barriers around them. And even countries, and I think this is the one that's a bit more controversial, even parts of the world like the European Union, which on the face of it have very low trade barriers, lower than the US in some cases, he feels they've been giving the US a raw deal by skewing the playing field in other ways. So he's just out to fix it all. It's broken and it's not fair to American workers. I think the question that's going to be hanging over the announcements later today, the end of the day European time, is whether this is a permanent shift that he's looking for.
Right.
Which, by the way, would also maybe raise some money. He's talked about getting a lot of tariff revenues from this to help the budget, or a first move in an effort to negotiate everybody's barriers down.
And this feels like the big question, right? Whether this is money that he wants to then fund the tax cuts, or whether this is a negotiating position. And depending on what the market interprets, I guess it could go either way.
Yeah, I think if you're sitting in the markets, and we will obviously be at 9 o'clock European time, 4 o'clock in the US, we will be there with our spreadsheets. We have our BECO models on the terminal. Our trade economists are ready to go, whatever he throws at us. But, we will, I think we will have the immediate impacts, but I think we'll also be assessing from the shape of what he's done, and whether or not this is mainly about making money, oversimplifying, or mainly about negotiation. And roughly speaking, I would say the lower the kind of headline rates are, the more you would tend to think, OK, he doesn't necessarily want to fundamentally unpick supply chains here. He wants to make a bit of money. He wants to charge an entry fee for the US market. He doesn't want to actually force people to change their production. And the interview he did with our own editor-in-chief, he kind of actually suggested that last summer. He said sometimes you have a very high tariff barrier when you really want to bring things back. I think cars is probably a case where he really wants a lot of car production to come back to the US. He doesn't think Mexico and Canada are close enough. But in other areas, maybe he just wants to charge a price of admission.
So what's the right way? And I find it surprising that, we understand through our reporting in Washington and your great team out there that they're still trying to figure out what the right balance is. And so is there a way of doing tariffs that doesn't really hurt inflation too much, that doesn't really hurt growth too much?
Well, you get the sense, and this was true to a lesser extent in the first Trump administration, but there are plenty of voices within the administration. I think Scott Bessent to some degree, Stephen Moore potentially, I think, or Kevin Hassett certainly, that are looking for ways to do this in a methodical way to give countries a chance to lower their trade barriers and end up with a kind of win-win. But they're constantly pushing against a much more extreme version of this, which I think Donald Trump kind of feels in his bones, which is much more about the more dramatic thing, bringing production back to the US, whatever it costs. He said in a Fox interview last weekend, I don't care if US car makers increase the price of cars. I mean, that is a very interesting statement.
Yeah, because he could crash the economy, essentially. Or is that going too far? But you could see a situation where there's not enough, investment spending because chief executives don't really know what they're looking at, even in the US. And the employment market starts to get a big hit.
Yeah, and this is actually one of the questions that the Federal Reserve has been grappling with, because you want to, if this is a sort of semi-permanent, quite significant increase in US average tariffs, we're pretty sure we're going to go back to the highest level since the 30s, and maybe, depending on what the reciprocity looks like, could be higher than the 1930s, the infamous Smoot-Hawley levels. If we go back to that, and if it's permanent, right, does that just add to inflation, or does it actually not add so much to inflation because you've really crimped the economy, because you're cutting jobs, because companies are pulling back? And I don't think we don't know the answer to that, but I think the Fed is tending to feel there's a stagflationary impact. So there's a hit to the economy. Some of our measures look like it could be 3 or 4% of GDP over a few years, and you get a step change in inflation which doesn't go away.
So what do you think will happen? Will they try and calibrate it so that it doesn't, so that actually it's built up to be a big success? There's a lot of pageantry. They've invited lawmakers. They probably don't want markets to crash on the back of it.
Well, this is what you have to wonder. So much has been around. I mean, we've been so wrong in so many days in thinking about what the reasonable, predictable thing to do would be from this White House, and we don't necessarily get that. But I do wonder whether he would be. It seems quite likely that the president would want to have a day where the market's relieved on balance. So we've had all this kind of apocalyptical talk, and then the headline number is low enough that people say, OK, this is going to shrink global trade. At the margin, he can declare victory, but it's not as bad as we thought. And then he will really declare victory if the market ends up on the day. But I would say we have so far overestimated how much he was going to focus on the stock market, and that may be true again.
Yeah, so Europe is an interesting one because we know that the Commission is basically preparing a package that they could use. What about China? Is this the first time where we really understand what kind of relationship President Trump wants with President Xi? For the moment, it feels like also PBOC have been on guard so as not to make U.S. mad.
Yeah, and I think we'll see, the US, in a way, China is obviously has got the most kind of across-the-board measures from this administration already. It has that 10%, something that didn't happen in the first Trump administration, right off the back across all consumer goods, retail goods. So they've been absorbing that. They've responded in a fairly targeted way. It will be interesting to see how much more is added to those in this. And then I think the Chinese have wanted to make a play of, we're still the good citizens in the global trading order. So whatever they do, you think, well, they will at least want to present it as working within the rules of a system that actually the US is kind of seeking to upend.
I love your podcast. It's called Trumponomics, and I think there's a new episode out today where you focus on the flip side, right, on Europe and whether maybe some of this is to blame on Germany.
Well, yes, Germany and other countries with imbalances. We're doing a bit of blaming the victim because, I think people, especially watching Bloomberg, will see plenty of economists expressing the very common view, the very, in many ways, very widely held view that this is not the way to address global imbalances. But the underlying imbalances have been an issue that economists on Bloomberg and everywhere else have talked about for years. And actually we have. I have to be careful saying this, but, the chief economic commentator for the Financial Times is joining me to discuss it on the podcast. There
you go. Listen to the podcast. So thank you so much. As always, Stephanie Flanders, our head of economics and government with Trumponomics out today, right now. Now, the U.S. Commerce Secretary will be also on Bloomberg surveillance on Thursday. Catch that conversation 1:30 p.m. London time. Up next, Bloomberg Brief.